Recent headlines just reveal a striking statistics. Mutual fund inflows have dropped by a massive 40% as investors react to market uncertainty. It shows exactly how quickly we let fear dictate our actions. But do you know that some of the best investment decisions are actually decisions not to act? When markets rise, we feel the need to buy. When markets fall, we feel the need to sell. When new channels flash breaking headlines, we feel the need to react. Somehow, doing something feels productive, but investing doesn't always reward activity. Now, before you interpret this as just sit tight and do nothing, stay with me till the end. Because successful investors are not inactive by default. So, what allows them to remain inactive when everyone else is reacting? In fact, many of the biggest investing mistakes happen when investors feel compelled to act. They switch funds, they chase recent winners, they book profits too early, or they abandon a well constructed plan because of temporary uncertainty. The truth is that successful investing is often surprisingly uneventful. But there's an important distinction. Inactivity is not a strategy, it is the discipline that follows a strategy. Before an investor can afford to remain still, they must first build a portfolio aligned with their financial goals, time horizon, liquidity needs, and risk profile. They must establish an appropriate asset allocation between growth assets and stability assets. Only then does this patience become valuable. A good portfolio is designed to survive market volatility. A good asset allocation is designed to handle uncertainty, and compounding works best when it is left uninterrupted. Yet, many investors confuse inactivity with laziness. It's not. Consider the environment investors are experiencing today. Inflation remains a concern. Crude oil prices continue to influence market sentiment. Bond yields are impacting valuations. And every day brings a new headline about geopolitics, central banks, or corporate earnings. In such an environment, many investors feel they must constantly do something: shift to fixed deposit, move to gold, increase equity exposure, reduce equity exposure, or wait for the clarity. But reacting to every headline is rarely a successful investment strategy. The question is not whether uncertainty exists. The question is whether your portfolio was built to handle uncertainty in the first place. Inactivity is often discipline. It is the discipline to ignore noise, the discipline to avoid emotional decisions, the discipline to stay invested when markets are uncomfortable, and the discipline to allow time to do its job. Because wealth creation is rarely driven by few brilliant decisions. More often, it is driven by avoiding a series of unnecessary mistakes. The longer I work in financial planning, the more I believe this. Successful investing is rarely about constantly doing more. It is about first building the right plan and then having the discipline to stay committed to it. Because inactivity is not laziness, it is often the financial discipline required to succeed in the game of investing.